We will start up with chapter number 14, Central Banking. Central Bank is also known as the apex bank of the country. Right? Apex, A-P-E-X, apex or the head bank of the country, and the apex bank of our country is Reserve Bank of India. That's also known as RBI. Alright, so apex bank or central bank is the bank which is controlling the functions of all the other commercial banks that are in the country. So this is the head bank or the apex bank, that's the Reserve Bank of India. It is controlling the functions and the policies of the country's other banks. So it enjoys the apex. That's the apex is basically the highest position. Apex is the highest position in the country's monetary and banking structure. It regulates the monitors and bankers and monetary system in the country. In India, the Reserve Bank of India is the central bank. It was established in 1935. You know, it was established in 1935, Reserve Bank of India. Some of the prominent central banks include, you have Bank of England, Federal Reserve Bank of US, and People's Bank of China. So these are all the apex banks of the different countries. In our country, Reserve Bank of India is the apex bank, or it is a central bank, and it is controlling all the other commercial banks of the country. See, I'll just let you know the definition. Bank we have a definition given by some economists. A central bank is one which constitutes the apex of the monetary and banking structure of its country, and which performs as best as it can in the national interest certain functions such as note issue, banker to the government, banker to the banks, and custodian of country's foreign exchange reserves. So these are the few functions of the Reserve Bank of India, right? We will now study the functions of central bank at length. We have functions of central bank. We have the monetary functions and we have the non-monetary functions. This is monetary functions. Monetary means something that is connected with money. Alright? And we have the non-monetary functions, right? So these are the two major functions that are performed by the central bank, or that is monetary functions, and we have divided into two. First is monetary function and the second is non-monetary function. We will study that under these two, monetary and non-monetary functions, there are different functions. First is you have issue of currency notes. Alright. Second one you have is banker's bank. Next monetary function is custodian of forex reserves, credit controller. Alright. Last is banker to the government. Alright. These are some of the monetary functions of the central bank. We have some non-monetary functions also, as banks supervision. Alright. Then you have development functions, research. Alright. Then we have the data collection and clearances. These are some of the non-monetary functions performed by the central or the apex bank of the country. Let us study these monetary and non-monetary functions in detail. We will first study the monetary functions of the central bank. First function that we will study is issue of currency notes. The central bank has the authority to issue currency notes. You know, whatever currency notes are running in the economy, only the central bank or the Reserve Bank of India has the authority to issue those currency notes. It is not that any government authority or any government department or any bank of the country can issue currency notes. How many number, which denominations, all that is decided and issued by the central bank of the country. The RBI enjoys the monopoly of note issue. The RBI has been authorized by the government of India to issue the notes of all denominations except 1 rupee, which is at present it's not in circulation. The 1 rupee note is directly issued by the government of India. All the notes are issued by the RBI except the 1 rupee note. The 1 rupee note is issued by the Government of India. In India, every note issued is backed by an asset of equal value. The assets include gold, foreign currencies and securities. The main advantage for the monopoly of note issue by central bank is it brings uniformity in note circulation. If there is only one authority who is circulating the note, then it knows how many it has to circulate, where it has to stop, where it has to begin. So having a monopoly in the note, issuing the currency notes, it enjoys the monopoly, and because of that monopoly there is uniformity. It facilitates effective supervision of RBI over currency notes. So it is issuing, and first it has uniformity, right? It has effective supervision also over it. If it has effective supervision, it can control the running of money in the economy. Problem of overissue. There it avoids the problem of over issuing the notes, because it has the only power, so it knows how many it has issued earlier, how many are there in the economy, and how many it would have to issue it at a later stage. It develops confidence in public's mind. So these is avoided. So these are some of the important, you can say, the merits of issue of currency notes only by the central banks. Next monetary function performed by the central bank is banker to the government. Banker to the government. This is the second function of the central bank. The central bank acts as a banker, agent and advisor to the government. You know, it is a banker to the government means it acts as any other banker to any other common man. So it provides all the help, guidance, directions required by the government. So central bank is helping the government in all the ways it can. It transacts all the banking business of the central government. Whatever functions, basically government here is the central government they mean, and whatever help is required by the central government, whatever money, how much money it is earning, how much it will be spending, and whatever business are transacted, that is all managed by the central banks. It accepts money on accounts of the government and makes payment on behalf of the government. It makes temporary advances. If the government wants the loan, it takes it from the central bank. If the government wants any money to meet any emergencies, then also it takes money from the central banks. So it is like an agent to the government, and it is also like an agent to the government, and it is like an advisor to the government. So agent, it manages public debt and is responsible for the issue of new loans. It maintains exchange rate, and it also assists the government in maintaining financial relations. This is how it acts as an agent. But as an advisor, it advises the government when to control inflation, deflation that has taken place, when it should take the loan, what are the rates that are prevailing, and what is the resources that are actually with the government, how should it keep back its expenses, curtail its expenses, and how it should disburse its income. So it is like the banker's bank to the government. This is one of the monetary function of the central bank. Next is, it is the banker's bank. Banker's bank means it is a bank to the government, it is the bank to the other banks, right? So the central bank acts as a banker to all the other banks in the country. Banker's bank. So all the banks are controlled by this bank. In this respect, the following are the functions. You know what the functions of the banker's bank? It is lender of the last resort. Lender of last resort. The central bank acts as a lender of the last resort to the commercial banks. You know, commercial banks, whenever they face any kind of problem, whenever they face any kind of liquidity problem, they always seek the help of the central bank, right? Whenever any crisis, any liquidity problem, all the funds are available with the central banks. So that is why it is the lender of the last resort. Next is custodian of cash reserves. You know, it is also known as CRR, cash reserve ratio. Now what is that CRR? Commercial banks have to maintain a certain percentage of total deposit in the form of cash reserve ratio with the central bank. The central bank pays interest to the banks on CRR. The CRR enables RBI to advance funds to the banks that face temporary liquidity. If there is any, see what happens. If I am suppose any bank of the country, you say I am the State Bank of India. Now whatever deposits I get from the people, from that deposits I have to maintain certain percentage with the, I have to keep that, from that deposits I have to keep certain money with the central bank in my name. So in central bank's office there will be one account of mine or one locker for me that will be known as cash reserve. Some reserve of money or some money out of those deposits are kept with the which bank? The central bank. So that percentage is known as the cash reserve, and there is a ratio of money, that total money I have, and from that money I have given to the central bank. So that is the cash reserve ratio. Basically what happens, the cash reserve ratio, that is made because if you need to have, and in that reserve that you have kept with, or the deposit that you have made with the central bank, on that deposit the central bank pays you some interest also. Alright, and in the case of if you as a bank, if I as a State Bank of India, I require some money because I am facing some problem, so I can keep that money which you have kept as a deposit, I can keep it as a loan and I can take money on that deposit. So it is a custodian, that your money is in custody with the central bank. Next is clearing house. The central bank acts as a clearing house for all the commercial banks. It clears interbank transactions, since all the banks have their accounts with the central bank. Every bank has an account with the central bank. The claims of banks against each other are settled by simple transfers. See, if I have drawn a check, if I am State Bank of India, I have got a check, my person who has an account in I have a check for the State Bank of Maharashtra. So what will happen? There is a place known as clearing house when the transaction of each other's banks are settled. If I have to give your money, I will give your money. If there is some check that is deposited in my bank, I will take it from you. So that is known as a clearing house, and that function is performed by the central bank. So due to the clearing house, interbank transfers of funds is economical and time saving to the banks. So these are some of the functions of the monetary functions. We will discuss more monetary functions. Next monetary function is controller of credit. The central bank has a responsibility to control the credit in the country. The central bank regulates the volume of credit and money supply in the country. Controller of credit means it is controlling what? The money supply in the country. Alright, so it is controlling the credit or controlling the money supply in the country. The credit or money supply is decreased due to inflation, and the credit or money supply is increased so that the banks lend more funds to the various sectors. So it is controlling the money. It is controlling the money means if I want that money should be less circulated in the market, then what will I do? I will ask the banks, I will take money from the banks, I will increase the cash reserve ratio so that there will be more money with me, less with the banks. If banks have less money, they will give less to the people. So automatically the purchasing power will go down. So there are certain methods, fiscal and monetary methods, through which it is controlling the credit in the economy. You have quantitative controls and qualitative controls. You have repo rates, then reserve repo rates, you have CRRs, and qualitative measures you have marginal requirements, issuing directive to banks, etc. So this is known as the control of credit, and this is one of the monetary functions. Last monetary function is custodian of forex. Custodian of forex means foreign exchange reserve. Foreign exchange reserves. This is known as forex. a country maintains some reserves also. The foreign exchange reserves also in the form of gold drawings, SDRs जिनको हम बोलते हैं, that is special drawing rights in foreign currency. The foreign exchange reserves indicate a sound balance of payments. Whatever money is coming in, you have to maintain certain amount of the money. So if more money is coming, means you have a favorable cash balance of foreign. If less money is coming in the country, it means the balance of payment or balance of trade is going down. A good amount of foreign exchange reserves helps to maintain exchange rate stability. So these were some of the monetary functions of the central bank. We will now do the non-monetary functions of the central banks. Non-monetary functions of the central bank. First is supervision of banks. Supervision of banks. The central bank supervises and monitors the working of all the commercial banks, right? RBI has been given the powers that all the commercial banks of the country will be working under the central bank. So it is supervising, monitoring and controlling the other functions, performances and functionings. Promotional and developmental functions, that is, there are the central bank also performs the promotional functions. You have certain banks that have been set up by the central bank. You have the NABARD, if you have heard, NABARD. NABARD is the National Bank for Agricultural and Rural Development. National Bank for Agricultural and Rural Development, that is set up to promote agricultural and rural development. And you have the Exim Bank also. You have the Exim Bank, that is export and import banks, export and import, and this is also promoting. You have National Bank for Agricultural and Rural Development, and you have Export and Import Bank, that is it is set up for the upliftment of the rural agricultural and the rural sector. And Exim Bank is there to control the working or to see the export and imports of the country. So these are some of the promotional activities or functions, non-monetary functions performed by the central bank. Next is data collection and publication. The central bank collects data on various economic matters such as foreign trade, foreign direct investments, and there are market inflation and all. There are certain bulletins and publications that are often issued by that are often circulated, taken out and circulated by the central bank on different matters such as foreign trade, foreign investment, and it publishes them. Such information is useful for business firms and other organizations. Many people who are undertaking their research studies and all, they collect or use the data by the bulletins that is published by the Reserve Bank of India. That has very valuable information. Next is clearances. Clearance is one of the non-monetary functions. The central bank clearance to various proposals to involving financial considerations. It also has some clearances, means giving a clean chit to many financial collaborations with the foreign countries. There are some joint ventures also that the Reserve Bank undertakes, and it clears proposals from Indian firms to invest in foreign countries. There are certain people who take the help, because whenever you are getting into trade with the foreign country, you need to seek advices or from this Reserve Bank, and Reserve Bank has all the proposals and reports sent by you. So it is the Reserve Bank or the central bank which gives yes to your proposal. If the central bank does not like your proposal, that is you're working with the foreign countries, then definitely your work will not proceed. It will stop then and there. So in order to have work with the foreign countries or in collaboration or joint venture with the foreign countries, you need to have to submit a report or a proposal to the central bank. If it is cleared, you can proceed further, otherwise not. Last is research. The central bank undertakes research work in respect of banking and other economic matters. The research work is useful to government authorities to frame various macroeconomic policies, trade policies, monetary policies. So government, the central bank, as I said, the central bank is controlling the functions of the other banks prevailing in the country. So it also undertakes research activities and seeing whether there is inflation in the country, deflation in the country, monetary policies, fiscal policies, taxation policies. It studies everything, undertakes a good and in-depth research, and then it formulates the policies for the future periods. So these were some of the monetary and non-monetary functions performed by the central bank. Next is you have methods of credit control. Credit control measures refer to the measures that are adopted by the RBI to increase or decrease the credit or the money supply in the country. Credit control means you have to control the money supply in the country, right? Controlling the money supply in the country is known as the credit control, and that is undertaken by the RBI or the central bank of the country. If there is more money supply, it will lead to inflation, and therefore all the measures will be to restrict the money supply, right? So now you have the credit control measures. Certain measures that we will study are qualitative credit controls, you have quantitative credit controls, and you have qualitative credit controls. These are the two methods of controlling the credit in the economy, right? You have the quantitative credit control, you have the bank rate, you have different methods. First you have the bank rate, next is you have the open market operations, next you have the cash reserve ratio, and the last you have the statutory liquidity ratio. Next you have the qualitative credit control, you have the ceiling on credit method, right? Then you have margin requirements, directives, and last you have the moral suasion. These are some of the quantitative and qualitative credit control methods. We will study each of these methods in detail. First is quantitative method. First is bank rate. The bank rate is the rate at which RBI lends money to the commercial bank. See, RBI is lending money to the commercial bank whenever commercial bank requires the money. Now the RBI sees that there are so much money in circulation in the economy, people have lots of money, so therefore the prices are rising, and that will lead to the situation of inflation. When there is lot of money supply in the market and people are spending money, so what it will do, it will increase the bank rate. That means it will increase the rate at which it is lending to the government, the other commercial banks. So what will happen? The banks will pay more in the form of interest, and it will borrow less. When it will borrow less means it will have less of the deposits. It will have less of the money from the central bank. If it has less money, it will lend less money. If it will lend less money, then what will happen? People will get less money and they will spend less. So that will control the inflation. Into April 2010, the bank rate was maintained at 6%. If the bank rate increases, that is the interest rate increases, and vice versa, through changes in the bank rate, RBI affects the interest rates in the money market. So it is RBI controlling the inflation deflation by one of the policy known as the bank rate. Next is open market operations. This involves purchase and sale of government securities. The open and market operations enable the balanced supply in the money. How? Purchase of government securities from banks. See what happens? Open market operations means when commercial banks, they also have their shares and securities. If the central bank wants that the money supply should increase in the market, so what it will do, it will buy the shares from the banks. When it will buy the shares from the bank, what will do, if I am the central bank, I am buying the shares, and what I am giving money, so the money balance with the bank will increase. If money balance with the bank will increase, it will give more to the people. If people will have more money, there will be supply of money will increase in the economy. So this is how open market operations are carried, and control of money supply is taken place with the help of open market operations. Next is cash reserves ratio, as I have already discussed. Cash reserve ratio is also known as CRR, also affects money supply in the economy. It is the percentage of the bank's deposits kept with the RBI. Whatever deposit I have in total of the, if I am any other commercial bank and there are many people who are depositing money with me, from that deposit I have to give certain amount to the RBI. Increase in CRR reduces the cash for lending and a low CRR increases. If I am giving more of my reserves to the central bank, then I have less of money with me and I can lend very less money to the people. Right? So this is how CRR controls the money supply. CRR was 15% in 91 and in April 2010 it was revised at 6%. Alright. Next is statutory liquidity ratio under SLR. This is also known as SLR. Under SLR, the government has imposed an obligation to the banks to maintain a certain ratio in total deposits with the RBI in the form of liquid assets like cash, gold and other securities, right? It has to maintain something statutory like in the form of gold or something. So that is known as liquidity, statutory liquidity ratio. The SLR has been reduced from 38.5% to 25% now. The reduction in CRR and SLR improves liquidity to the banks and lend more money in the money market. So if these ratios are low, then means you have more money, and if you have more money, you can lend more to the people. So these are some of the quantitative measures of the methods of credit control. Next is we will study the qualitative credit control measures. First, your selective credit controls have been taken to money supply in the market, either to increase or decrease the money supply specific purpose, right? The different qualitative credit control measures are: first is ceiling on the level of credit. Ceiling on the level of credit. The ceiling on the level of credit restricts the lending capacity of a bank to grant advances against credit control commodities or securities. The ceiling on the level of credit. Directly it is ceiling the level of credit. It tells the other bank you can provide credit only up to this limit. After this limit you are not permitted. So directly that is you are putting a ceiling or a restriction. Next is margin requirements. The RBI imposes minimum margin requirements which vary from 20 to 80% for lending against securities or commodities. They also lend against securities and commodities. See, this is also on securities and commodities. And margin requirement, people are putting their commodities and securities, and through that the banks are lending money. There is a ceiling also. Margin against a particular security is decreased in order to encourage or discourage the flow of credit to a particular sector. If you want that there should be more money, any lending on the security or commodity should be decreased, and vice versa. Next is directives. The RBI issue directives to the commercial banks regarding the advances. Some of the directives are, I'll just read out: minimum margin requirements, maximum limit on borrowers, percentage of CRR, minimum lock-in period, etc. Next is morals. Directives means it gives certain directions which have to be followed by every bank. Moral suasion. Under moral suasion, the RBI issues periodical letters to the banks to exercise control over credit. Such periodical letters act as a reminder to the bank to follow credit policies and norms. So moral suasion means you're putting the moral pressures. You're not doing anything. You're just sending letters and reminders to the commercial banks. Next is direct action. Right? The central bank may take direct action on the commercial banks for not observing the guidelines. Certain guidelines and directives are issued by the central bank to the commercial banks, and if they are not followed, then if they are not complied, then they will a direct action will be taken by the RBI. If guidelines are not followed, central bank may impose penalty on defaulting banks. Then last is publicity. Central bank publishes regarding information, money and market and credit situation in the market. This information can be useful in framing credit policy and fixing interest rates. So the research work is undertaken, and with the help of that research work, publicity, some of the articles, journals are published by the central bank, which helps to determine the policies different control measures, the interest rates for the commercial banks. These were some of the credit control measures, the quantitative and qualitative. You may also be asked about the distinction between commercial and credit the central banks. Alright, so there is a lot of difference between the commercial and the central bank. Then you have the differences of quantitative credit control and qualitative credit control that we have just done. Next, you may be asked upon bank rate and open market operations, and bank rate and interest rate. So these are some of the differences that may be asked in the examination and which has to be done very thoroughly. So this was the chapter of central banking, and these were some of the important points that we undertook in this chapter.